A company was usually rewarded when it raised its capital spending. But as those numbers keep going up and the companies issue more debt to pay for some of that, some investors are getting a little bit jumpy. And that might give the company widely seen as an AI laggard a bit of an edge. We've got both of those angles as part of today's Tech Check. Seema Mody tracking just where those concerns are showing up in the credit markets. MacKenzie Sigalos looking at how Apple's sort of anti-capex bet is gaining momentum. Seema, we're going to start with you. Talk to us about the debt side.
Well, what's clear, Brian, is investors are getting increasingly uncomfortable with the amount of capital needed to make their AI dreams become a reality. And it's playing out real time in the bond market, where the biggest names involved in the artificial intelligence build out, think about Google, Amazon, Meta, they're seeing their credit spreads widen. So in other words, fixed income investors are demanding more reward to lend to these companies that have all raised their AI spending targets in the last few months and are on track to collectively spend more on capex than they generate in free cash flow by next year. Mizuho writing this morning that investors are starting to ask where the limit is. And just today, the FT reporting that bond investors are requiring a 7.5% rate to finance Meta's 1 gigawatt data center in Texas. Brian, that's higher than previous projects. And just to gauge how concerned bond investors are getting about capex, you got to watch Oracle's 5-year credit default swap. Barclays writing that it's no longer just trading on company fundamentals, but sort of seen as a liquid hedge on concerns tied to capex spending and, yes, its reliance on OpenAI.
And we've got that chart up right alongside you, Seema. I don't know if you have a monitor there,
Yep,
but we know the credit default swaps, which we talked a lot about in 2007, 2008, and 2009. When they go up, that tends to be a bad thing. Right? Up is not good when it comes to it's good when it comes to stocks, but CDS is going up means risk is rising.
Yes, exactly. The cost to insure against the prospect of a default rises, and that's exactly what is being telegraphed in this chart. You know, what's so interesting, Brian, is when the AI investment cycle kicked off, hyperscaler bonds, and as well as Oracle, were seen as an attractive bet for fixed income investors. For most of these companies, they're investment grade. Take a look at Microsoft, better rating than the U.S. government. But now, as you point out, the capex targets continue to get raised. Wall Street has questions about just how much more they can tolerate and how that's going to impact their balance sheet. I'm very interested 12 months from now, Brian, what these balance sheets look like and how much debt they take on.
Yeah, usually when charts go up, we're like, oh, it's a good thing, but not CDSs. Like if your car insurance or home insurance rates go up, not a good thing. It means your perceived risk is higher. CDS the same way. Seema, glad you're on the story. Thank you very much.
Thank you.
All right, let's turn now to part two. MacKenzie Sigalos with how Apple's approach to AI spending might actually give it a leg up, because I guess in this case, if the chart goes down, less spending, some people are happy.
Exactly. So you've got Apple heading into earnings with its anti-capex AI strategy really gaining fresh validation as these Chinese open source models show that companies don't need frontier level models to win in generative AI. Now, after years of taking heat for moving too slowly with its AI strategy, Apple's virtually non-existent infrastructure spending is now working in its favor. Alphabet beat nearly every measure of the return on its AI spending and still had its worst day in 3 years, dragging the broader hyperscaler group lower on Thursday as investors focused on how much more cash the build-out will consume. The group is now on pace to spend $800 billion on infrastructure this year, another $1.2 trillion next year, but Apple, it's tracking toward $14 billion in capex for all of 2026 and has returned more than $1 trillion to shareholders since its capital return program began. That makes Apple the clearest alternative among mega cap tech to the AI infrastructure trade. Its capex was below $2 billion last quarter. That is 4% of what Alphabet spent in Q2. And it's used this playbook before. Apple outsourced search to Google, collected billions for the distribution, and then avoided the cost of building a rival search engine. And now it's doing the exact same thing in AI, relying on Alphabet for the models and heavier cloud workloads, then distributing that tech across more than 2.5 billion devices and monetizing it through hardware and services. And that capital-light model, a big reason the shares are up more than 30% since March, Brian.